CNBC getting an exclusive first look at the July Cass Freight Index, which measures numbers for volumes and costs for the freight market. Many U.S. companies have flagged shipping costs or delays as a headwind. Frank Holland joins us now. What are the latest numbers showing, Frank?
Hey, good morning, Melissa. Well, freight volumes, they returned to pre-pandemic levels last month. Just 0.5% higher than July of 2019, still about 16% higher than 2020, right at the height of the pandemic. This year, COVID cases were on the rise because of the Delta variant, so kind of an interesting parallel there. Over the last 3 months, freight volumes have declined sequentially, but remain really elevated compared to 2020 and 2019. However, bottlenecks getting containers off of ocean ships is likely artificially lowering those volumes, and a big rebound leading up to the holidays is very likely, according to this report's author. The cost of shipping declining, but still near historic levels, a 23% increase from those 2019 numbers. Bernstein analyst David Vernon says retail and grocery companies are expected to see the sharpest cost increases.
Companies in the food industry, companies in the retail industry that use a lot of trucks in their supply chain, it's just going to mean there's going to be margin pressure.
So the shortage of truck drivers is another factor pushing rates higher. Trucking is about 80% of all supply chain spend. The report says that despite the Delta variant and cases rising, it still appears that hiring momentum is increasing. And you can find a link to the full report on CNBC.com.
Are there certain industries, Frank, where we're seeing the shortage impact more profoundly than others?
Well, I mean, food and retail is where you're going to see it more, just at least initially, because they need to ship things in more often. Imagine a Walmart. The example that Dave Vernon gave me is actually cornflakes. You don't make a lot of money on a box of cornflakes. They're not very heavy, but they take up a lot of room. So you still have to pay the same amount to ship them as you would a box of sneakers that are a much higher margin product. So food companies, retailers that don't sell high margin products, they're going to feel the impact first.
Hey, Frank, I'm looking at a tweet that somebody sent me just a few moments ago. It says, we move 100,000 containers a year. The freight data is horrific. Normal time, Shanghai to Chicago, 23 to 25 days, now 50 to 60. Pricing was $3,500, now $17,500. Forecast is for continuation through March of 2022.
Yeah, that's what analysts are really saying and echoing. I just got the latest information on container volume that's available. Demand's up about 30% over the same period in June of last year. Still waiting to get those July numbers for containers. It's definitely a big issue. We see the delays at ports, the increased volumes at ports. There's a lot of demand that's literally sitting in the ocean waiting to come into the United States. There still is a truck driver shortage. And there's still the factor of intermodal, which is getting those containers off the ship and then onto land, either through a truck or a train. Those volumes are up 15% year over year. So just log jams and pressure points at pretty much every step of the U.S. supply chain.